Question 1. Governance review demonstrates a pattern of near misses and one confirmed incident of significant patient harm attributed to a surgical error at a large hospital. The surgical team involved in the confirmed incident failed to adequately document a deviation from standard protocol, which was subsequently identified by a peer review committee. The attending physician, while acknowledging the error internally, expressed concern about the potential impact on their medical license and hospital accreditation if the incident is formally reported through all required channels, suggesting a more discreet internal resolution. As a professional liability insurance specialist, what is the most appropriate course of action? Option A. Recommend that the hospital leadership handle the matter internally, focusing on staff retraining and policy updates, and only report the incident externally if a formal patient lawsuit is filed. Option B. Immediately initiate the formal reporting process to the relevant state medical board and the professional liability insurer, while ensuring all patient privacy is maintained in accordance with HIPAA, and facilitate the hospital's internal risk management investigation and corrective action plan. Option C. Disclose the details of the surgical error and the involved physician's identity to a medical malpractice plaintiff's attorney who has previously inquired about potential cases at the hospital to expedite the claims process. Option D. Advise the attending physician to document the deviation from protocol as a minor oversight and focus on implementing additional training for the surgical team to prevent future occurrences without formal external reporting. Correct answer is B. Immediately initiate the formal reporting process to the relevant state medical board and the professional liability insurer, while ensuring all patient privacy is maintained in accordance with HIPAA, and facilitate the hospital's internal risk management investigation and corrective action plan. Explanation. This scenario presents a significant professional challenge due to the inherent conflict between a healthcare provider's duty to protect patient privacy and the legal obligation to report potential malpractice that could endanger other patients. The core of the challenge lies in balancing these competing ethical and legal imperatives. A professional liability insurance specialist must navigate this complex situation with meticulous attention to regulatory compliance and patient safety. The correct approach involves a multifaceted strategy that prioritizes patient safety while adhering strictly to HIPAA and state-specific reporting requirements for medical malpractice. This approach necessitates immediate internal review of the incident, thorough documentation, and prompt reporting to the appropriate regulatory bodies and the insurer, all while ensuring that patient confidentiality is maintained to the greatest extent possible within the bounds of the law. This aligns with the principles of risk management in healthcare, which emphasizes proactive identification and mitigation of potential harm. The specialist's role is to facilitate this process, ensuring that all legal and contractual obligations are met, thereby protecting both the healthcare provider and the patients. An incorrect approach would be to ignore the incident or attempt to handle it solely internally without proper reporting. This failure to report potential malpractice to regulatory bodies and the insurer is a direct violation of numerous state medical practice acts and professional liability insurance policy conditions. Such inaction not only exposes the healthcare provider to significant legal and financial penalties, but also fails to protect future patients from potential harm, a clear breach of the standard of care and patient safety principles. Another incorrect approach would be to disclose patient-identifying information to parties not authorized under HIPAA, such as casual discussions with colleagues not involved in the case or external parties, without a valid need-to-know or patient authorization. This constitutes a HIPAA violation, leading to severe penalties and eroding patient trust. While the incident may involve potential malpractice, the reporting process must be conducted in a manner that respects patient privacy rights as mandated by HIPAA, unless specific exceptions for reporting medical errors apply and are followed correctly. A third incorrect approach would be to delay reporting to the insurer or regulatory bodies due to fear of increased premiums or reputational damage. This delay is a breach of the insurance contract and can be construed as an attempt to conceal a potential claim, which can lead to denial of coverage and further legal complications. Professional liability insurance policies require prompt notification of incidents that could reasonably lead to a claim. The professional decision-making process for similar situations should involve 1. Immediate assessment of patient safety and any ongoing risks. 2. Thorough factual investigation of the incident, adhering to established protocols. 3. Consultation with legal counsel and the healthcare institution's risk management department. 4. Strict adherence to HIPAA guidelines regarding any disclosures. 5. Prompt and accurate reporting to the professional liability insurer and any required state regulatory agencies, following established reporting timelines and procedures. 6. Maintaining comprehensive and confidential documentation of all actions taken. Question 2. The efficiency study reveals that a significant number of audit files from the previous financial year contain insufficient supporting documentation for key audit assertions, and simultaneously, several tax advice letters issued to clients contain demonstrably incorrect interpretations of recent HMRC legislation, leading to potential underpayment of tax liabilities. What is the most appropriate immediate course of action for the accounting firm? Option A. Focus solely on rectifying the audit documentation deficiencies by backdating supporting documents where possible, and inform tax clients that any tax adjustments will be handled during their next annual tax filing. Option B. Initiate a formal investigation into the individuals responsible for the errors, and communicate only with clients whose tax liabilities are confirmed to be significantly impacted after the investigation concludes. Option C. Advise clients that the audit documentation issues are a standard part of internal review, and that the tax advice errors are minor and unlikely to result in significant penalties, while discreetly updating internal tax guidance. Option D. Immediately inform all affected clients of the identified audit documentation deficiencies and tax advice errors, detailing the nature of the issues, potential consequences, and proposed remedial steps, while also initiating a review of internal audit and tax advisory procedures. The correct answer is D. Immediately inform all affected clients of the identified audit documentation deficiencies and tax advice errors, detailing the nature of the issues, potential consequences, and proposed remedial steps, while also initiating a review of internal audit and tax advisory procedures. Explanation: this scenario presents a significant professional challenge for an accountant due to the potential for substantial financial loss to clients and reputational damage to the accounting firm. The core of the challenge lies in the accountant's dual responsibility to provide accurate and compliant tax advice and to conduct audits with due care and professional skepticism. A failure in either area can lead to severe consequences, including regulatory sanctions, civil litigation, and loss of client trust. The accountant must navigate the complexities of tax law, audit standards, and ethical obligations simultaneously. The correct approach involves a thorough review of the audit findings and the tax advice provided, identifying the specific errors, and then proactively communicating these errors to the affected clients. This communication should include a clear explanation of the nature of the errors, the potential consequences, e.g., penalties, interest, and proposed remedial actions. This approach aligns with the fundamental ethical principles of integrity, objectivity, and professional competence, as well as regulatory requirements for disclosure and client care. Specifically, under the Professional Standards for Accountants, PSA, and the Institute of Chartered Accountants in England and Wales, IQ, Code of Ethics, accountants have a duty to act with integrity and competence, and to take reasonable steps to avoid misleading clients. Prompt and transparent disclosure of errors is crucial to mitigating harm and maintaining professional credibility. An incorrect approach of attempting to conceal the errors or downplaying their significance would be a severe breach of professional ethics and regulatory standards. This would violate the principle of integrity, as it involves dishonesty. It would also contravene the duty of care owed to clients, as it prevents them from taking timely corrective action, potentially leading to greater financial penalties and legal repercussions. Such concealment could also expose the accountant and firm to further disciplinary action from regulatory bodies, including fines and suspension or revocation of practicing certificates. Another incorrect approach would be to blame external factors or other parties without taking responsibility for the firm's role in the errors. While external factors may contribute, the accountant's professional responsibility is to ensure the accuracy of their work and advice. Shifting blame without acknowledging and addressing the firm's own failings demonstrates a lack of accountability and professional maturity, which is contrary to the principles of professional competence and due care. A further incorrect approach would be to offer a perfunctory apology without providing concrete solutions, or taking steps to rectify the situation. While an apology is a starting point, it does not fulfill the accountant's professional obligation to their clients. Clients expect not only an acknowledgement of error, but also a clear plan to address the consequences and prevent recurrence. Failure to provide such a plan would be a dereliction of professional duty. The professional decision-making process in such a situation should involve 1. Immediate internal review to fully understand the scope and nature of the errors. 2. Consultation with senior partners or a professional indemnity insurer if the errors are significant. 3. Developing a clear, factual, and empathetic communication strategy for clients. 4. Proposing practical and effective remedial actions. 5. Implementing measures to prevent similar errors in the future, such as enhanced training or revised internal procedures. This structured approach ensures that all ethical and regulatory obligations are met while prioritizing client interests and safeguarding the firm's reputation. Question 3. Quality control measures reveal a scenario where a client alleges significant financial losses due to incorrect advice provided by a consulting firm regarding a complex investment strategy. The consulting firm holds both a general liability policy and a professional liability errors and omissions policy. The client's claim specifically states the losses resulted from the consultant's negligent professional advice. Which approach best distinguishes the applicable insurance coverage in this situation? Option A. The claim should be processed under the professional liability errors and omissions policy because the alleged damages directly stem from the rendering of professional advice, which is the core coverage provided by this type of policy. Option B. The claim should be denied outright, as financial losses are typically excluded from both general liability and professional liability policies. Option C. The claim should be split equally between the general liability and professional liability policies, as the consulting firm's business operations are covered by both. Option D. The claim should be processed under the general liability policy as it covers all third-party claims against a business, regardless of the specific nature of the alleged wrongdoing. Correct answer is A. The claim should be processed under the professional liability errors and omissions policy because the alleged damages directly stem from the rendering of professional advice, which is the core coverage provided by this type of policy. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of insurance policy distinctions, specifically differentiating between professional liability and general liability. Misclassifying a claim can lead to significant financial and reputational damage for both the insurer and the insured, as well as potential regulatory sanctions for the insurance professional. The core of the challenge lies in identifying the root cause of the alleged harm, which is the determining factor in policy coverage. The correct approach involves meticulously analyzing the facts of the claim to ascertain whether the alleged damages arose from a professional error, omission, or negligent act in the rendering of professional services. This aligns with the fundamental purpose of professional liability insurance, often referred to as errors and omissions or E&O insurance, which is designed to cover claims stemming from the failure to perform professional duties with the expected standard of care. Regulatory frameworks for insurance professionals emphasize the importance of accurate policy interpretation and claim handling, ensuring that coverage is applied according to the policy's intent and the insured's specific needs. This approach upholds the principle of utmost good faith and fair dealing expected in insurance contracts. An incorrect approach would be to automatically categorize the claim under general liability, simply because it involves a third-party allegation of harm. General liability insurance typically covers bodily injury and property damage arising from premises liability, operations, products, or completed operations, not from the rendering of professional services. Classifying a claim under general liability, when it clearly stems from a professional error, would deny the insured the coverage they specifically purchased through their professional liability policy, leading to a breach of contract and potential regulatory violations related to unfair claim settlement practices. Another incorrect approach would be to dismiss the claim outright without a thorough investigation into the nature of the services provided and the alleged cause of the loss. This demonstrates a failure to exercise due diligence and a lack of understanding of the policy's scope. Such an action could result in a failure to defend the insured, exposing them to significant legal costs and judgments, and could also lead to regulatory scrutiny for improper claim denial. Professionals should employ a decision-making framework that begins with a thorough review of the insured's policy, paying close attention to the definitions of professional services and the exclusions. This should be followed by a detailed factual investigation of the claim, focusing on the but for cause of the alleged damage. If the damage would not have occurred but for the professional's advice, judgment, or action or inaction in their professional capacity, then professional liability coverage is likely implicated. Conversely, if the damage arose from a physical hazard or a non-professional aspect of the business, general liability might be more appropriate. This systematic approach ensures accurate coverage determination and compliance with regulatory obligations. Question 4. Market research demonstrates that many small professional firms find the intricacies of professional liability insurance policies overwhelming. As a specialist, you are tasked with developing a client onboarding process that ensures informed consent for a new professional indemnity policy. Which of the following approaches best fulfills the regulatory and ethical obligations for obtaining informed consent in this context? Option A. Providing the client with a comprehensive policy document and a standard disclosure statement, followed by a brief confirmation that they have read and understood the terms. Option B. Engaging in a detailed interactive discussion with the client, using plain language to explain key policy features, limitations, exclusions, and potential implications for their specific professional services, while actively soliciting and addressing their questions. Option C. Relying on the client's prior experience with insurance to assume they understand the general principles of professional liability coverage, and only addressing specific questions they may raise. Option D. Presenting a summary of the policy's benefits and a high-level overview of coverage, without delving into specific exclusions or limitations unless explicitly asked by the client. The correct answer is A. Providing the client with a comprehensive policy document and a standard disclosure statement, followed by a brief confirmation that they have read and understood the terms. Explanation. This scenario presents a professional challenge because it requires an insurance specialist to balance the client's desire for a streamlined process with the absolute regulatory and ethical imperative of obtaining truly informed consent. The complexity arises from the potential for clients to feel overwhelmed by detailed explanations or to simply agree without full comprehension, especially when dealing with the nuances of professional liability insurance. Careful judgment is required to ensure the client understands the scope of coverage, limitations, exclusions, and the implications of their choices, rather than just ticking a box. The correct approach involves a proactive, multifaceted strategy to ensure informed consent. This means not only providing comprehensive policy documentation, but also engaging in a clear, understandable dialogue with the client. This dialogue should explain key terms, potential risks, and the rationale behind specific coverage recommendations or limitations in a way that the client can readily grasp. It requires active listening to the client's concerns and questions, and tailoring the explanation to their level of understanding. This aligns with the regulatory framework's emphasis on client best interests and the ethical duty to act with integrity and competence, ensuring clients make decisions based on a genuine understanding of the product and its implications for their professional practice. An incorrect approach would be to rely solely on the client signing a standard disclosure form without further explanation. This fails to meet the regulatory requirement for informed consent because it presumes understanding without verification. The client may sign the document without fully comprehending the critical details, leading to potential disputes or unmet expectations later. This approach prioritizes administrative completion over genuine client understanding and protection. Another incorrect approach is to provide a generic, overly technical explanation of the policy without tailoring it to the client's specific professional context or answering their questions patiently. This can lead to the client feeling confused or disengaged, undermining the informed consent process. While technical accuracy is important, the regulatory and ethical obligation is to ensure the client understands the information, not just that it has been delivered. A third incorrect approach is to rush the consent process due to time constraints or the client's apparent eagerness to finalize the policy. This haste can result in crucial information being omitted or glossed over, preventing the client from making a truly informed decision. The regulatory framework mandates sufficient time and attention to ensure the client's understanding, regardless of external pressures. The professional reasoning process for similar situations should involve prioritizing client understanding and protection above all else. This means dedicating adequate time to explain complex policy terms, using clear and accessible language, and actively seeking confirmation of comprehension. Professionals should adopt a client-centric mindset, anticipating potential areas of confusion and proactively addressing them. If a client appears to be struggling with comprehension, the professional has an ethical and regulatory duty to simplify the explanation, provide further clarification, or even suggest seeking independent advice if the complexity warrants it. The ultimate goal is to empower the client to make a well-informed decision that aligns with their professional needs and risk tolerance. Question 5. Stakeholder feedback indicates a recurring concern regarding physicians' approaches when a patient, after receiving a clear explanation of risks, benefits, and alternatives, chooses a treatment path that the physician believes is less optimal or carries higher risks than the recommended course of action. Specifically, how should a physician ethically and legally navigate a situation where a patient insists on a less conventional treatment option, despite the physician's strong recommendation for a standard, evidence-based approach, and the physician believes this choice could lead to suboptimal outcomes or increased complications? Option A. The physician should refuse to provide any treatment if the patient does not agree with the physician's recommended course of action, stating that they cannot be responsible for a decision they do not endorse. Option B. The physician should provide a comprehensive explanation of the risks, benefits, and alternatives of both the recommended and the patient's preferred treatment, ensuring the patient understands the potential consequences of their choice, and then proceed according to the patient's informed decision, documenting the entire process. Option C. The physician should strongly advocate for the recommended treatment, emphasizing the potential negative outcomes of the patient's preferred option, and subtly discouraging the patient from pursuing it to ensure they make the best medical decision. Option D. The physician should agree to the patient's preferred treatment without further detailed explanation, assuming the patient has sufficient understanding and is exercising their autonomy to avoid conflict. The correct answer is B. The physician should provide a comprehensive explanation of the risks, benefits, and alternatives of both the recommended and the patient's preferred treatment, ensuring the patient understands the potential consequences of their choice, and then proceed according to the patient's informed decision, documenting the entire process. Explanation. This scenario presents a professional challenge due to the inherent conflict between a healthcare provider's duty to act in the patient's best interest and the potential for financial repercussions or reputational damage. The core of the dilemma lies in balancing the physician's clinical judgment with the patient's right to make informed decisions about their care, even if those decisions deviate from the physician's recommendation. Navigating this requires a deep understanding of the principles of informed consent and the physician's duty of care within the regulatory framework governing medical professionals. The correct approach involves prioritizing the patient's autonomy and right to informed consent. This means clearly and comprehensively explaining the risks, benefits, and alternatives to the proposed treatment, as well as the consequences of refusing treatment. The physician must ensure the patient understands this information and can make a voluntary decision without coercion. This aligns with the fundamental ethical and legal principles of medical practice, emphasizing patient-centered care and the physician's fiduciary duty. Regulatory frameworks, such as those governing medical licensing and professional conduct, mandate that physicians obtain informed consent before undertaking medical procedures. Failure to do so can lead to disciplinary action, civil liability for medical malpractice, and erosion of patient trust. An incorrect approach would be to pressure the patient into accepting the recommended treatment by downplaying the risks of alternative options or exaggerating the potential negative outcomes of refusal. This undermines the principle of informed consent and violates the patient's autonomy. Ethically, it is manipulative and professionally unacceptable. Legally, it could be construed as a breach of the standard of care and a failure to obtain valid consent, potentially leading to a malpractice claim. Another incorrect approach would be to defer to the patient's wishes without providing adequate information or ensuring their understanding. While respecting patient autonomy is crucial, it must be exercised on the basis of informed decision-making. Simply agreeing to a patient's request without a thorough explanation of the implications is not true informed consent and could still expose the physician to liability if the patient later suffers harm due to a lack of understanding. This approach fails to meet the physician's duty to educate and guide the patient. A further incorrect approach would be to refuse to treat the patient altogether if they do not agree with the physician's recommendation, without exploring all avenues for communication and understanding. While a physician may have the right to withdraw from a case under certain circumstances, doing so solely because a patient exercises their right to choose an alternative, after proper informed consent has been discussed, could be seen as abandonment or a failure to uphold the duty of care, especially if no suitable alternative care is arranged. The professional decision-making process in such situations should involve a structured approach. First, clearly identify the patient's wishes and concerns. Second, thoroughly assess the patient's capacity to understand the information provided. Third, provide a comprehensive and unbiased explanation of all relevant medical information, including risks, benefits, and alternatives, using clear and understandable language. Fourth, actively listen to and address any questions or anxieties the patient may have. Fifth, document the informed consent process meticulously. Finally, if a significant divergence of opinion persists and patient safety is not compromised by the patient's chosen course, respect the patient's autonomy while ensuring they understand the potential consequences. Question 6. The efficiency study reveals that a significant portion of professional liability insurance policies are being adjusted based on a simplified, one-size-fits-all methodology. Considering the regulatory framework for professional liability insurance specialists, which of the following approaches to determining appropriate coverage limits and deductibles best aligns with the duty to provide tailored and effective client advice? Option A. Conducting a thorough risk assessment that considers the specific nature of the professional services, potential claim severity and frequency, the client's financial capacity, and any applicable regulatory mandates or industry best practices. Option B. Recommending the lowest possible premium by selecting the minimum coverage limits and highest deductibles that meet any statutory requirements. Option C. Relying exclusively on the client's historical claims data from the past 5 years to set coverage limits and deductibles, without considering current market trends or potential future risks. Option D. Suggesting the highest available coverage limits and lowest deductibles to ensure maximum protection, irrespective of the client's specific risk profile or financial constraints. The correct answer is A. Conducting a thorough risk assessment that considers the specific nature of the professional services, potential claim severity and frequency, the client's financial capacity, and any applicable regulatory mandates or industry best practices. Explanation. This scenario is professionally challenging because determining appropriate coverage limits and deductibles for professional liability insurance requires a nuanced understanding of the insured's business, potential risks, and the regulatory environment, rather than a purely mathematical exercise. The specialist must balance the client's need for adequate protection against the cost of insurance, while also ensuring compliance with any mandated minimums or industry best practices. A failure to accurately assess these factors can lead to underinsurance, leaving the professional exposed to significant financial loss or overinsurance, resulting in unnecessary premium expenses for the client. The correct approach involves a comprehensive risk assessment that considers the nature and scope of the professional services provided, the potential severity and frequency of claims, the client's financial capacity to absorb losses, and relevant regulatory requirements or industry standards for minimum coverage. This approach is justified because it aligns with the core principles of professional liability insurance, which aim to provide financial protection against claims arising from errors, omissions, or negligence. It also reflects the ethical duty of a specialist to act in the best interest of their client by recommending coverage that is both sufficient and cost-effective, ensuring the client is adequately protected without incurring excessive costs. An incorrect approach that focuses solely on the lowest premium ignores the fundamental purpose of insurance, which is risk transfer. This failure to adequately assess risk and potential loss exposure can lead to the insured being underinsured, a direct violation of the duty to provide appropriate advice, and potentially a breach of contract if the policy limits are insufficient to cover a claim. Another incorrect approach that prioritizes the highest possible coverage limit without regard to the client's actual risk profile or financial constraints is also professionally unsound. While it may seem to offer maximum protection, it can lead to unaffordable premiums, making the insurance inaccessible or financially burdensome for the client. This demonstrates a lack of understanding of the client's business needs and financial realities, and can be seen as failing to provide value. A further incorrect approach that relies solely on historical claims data without considering evolving risks, changes in the client's practice, or emerging legal precedents fails to provide a forward-looking assessment. Professional liability risks are dynamic, and past performance is not always indicative of future outcomes. This approach can lead to outdated coverage recommendations that do not adequately address current or future exposures. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's business and professional activities thoroughly. 2. Identify and quantify potential risks and liabilities associated with those activities. 3. Research relevant regulatory requirements, industry standards, and case law. 4. Evaluate the client's financial capacity and risk tolerance. 5. Propose coverage limits and deductibles that provide adequate protection while remaining financially viable for the client. 6. Clearly communicate the rationale behind the recommendations, including the trade-offs between coverage levels and costs. 7. Regularly review and update coverage as the client's circumstances or the risk landscape changes. Question 7. Compliance review shows that a software development firm, insured under a professional liability insurance policy, has reported a significant system failure resulting in a data breach for one of its clients. The failure occurred due to a coding error in a custom-built application developed by the insured. The client is seeking damages for the loss of sensitive customer data and the cost of remediation. Which of the following approaches best aligns with regulatory requirements and professional best practices for handling this claim? Option A. Deny the claim outright, citing a general exclusion for acts of God or unforeseen technical issues, without investigating the specific coding error or its direct link to the insured's professional negligence. Option B. Advise the insured to seek legal counsel and defer all communication and decision-making to them, without undertaking an initial assessment of coverage based on the policy and regulatory framework. Option C. Immediately offer a settlement based on the estimated cost of data remediation, without a detailed review of the policy's professional services clause or specific exclusions related to data breaches. Option D. Conduct a comprehensive review of the policy wording, focusing on the definition of professional services, any endorsements related to technology risks, and specific exclusions for data breaches or system failures, while cross-referencing with FCA Handbook, guidance on claims handling and fair treatment of customers. The correct answer is C. Immediately offer a settlement based on the estimated cost of data remediation, without a detailed review of the policy's professional services clause or specific exclusions related to data breaches. Explanation. This scenario is professionally challenging because it requires a specialist to navigate the intersection of evolving technology, potential client harm, and the specific regulatory obligations of professional liability insurance. The challenge lies in accurately assessing the scope of coverage for a novel technological failure and ensuring that the insurer's response aligns with both contractual terms and regulatory expectations for handling such claims. Careful judgment is required to avoid misinterpreting policy language or overlooking critical compliance steps. The correct approach involves a thorough review of the policy's professional services clause, specifically looking for definitions and exclusions related to software development, data handling, and system integrity. It necessitates understanding how the Financial Conduct Authority, FCA Handbook, particularly the Conduct of Business Sourcebook, COBS, and the Insurance Conduct of Business ICOBS, rules, applies to the handling of claims involving technology professionals. This includes ensuring fair treatment of the policyholder, accurate assessment of liability, and timely communication, all while adhering to the principles of treating customers fairly TCF. The regulatory justification stems from ICOB 6.1.1r, which mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients, and COBS 2.1.1r, which requires firms to act honestly, fairly, and professionally in accordance with the best interests of their clients. An incorrect approach that focuses solely on the immediate financial cost of the claim, without a comprehensive review of the policy wording and relevant regulations, would fail to uphold the insurer's duty of care. This could lead to an underpayment or denial of a valid claim, violating ICOB 6.1.1 1R and potentially leading to regulatory sanctions for unfair treatment of a customer. Another incorrect approach that relies on outdated or generic industry standards for technology errors and omissions, without considering the specific policy endorsements or exclusions, would also be professionally unacceptable. This overlooks the contractual agreement between the insurer and the insured, potentially exposing the insurer to unforeseen liabilities or unfairly denying coverage. This demonstrates a failure to act professionally and in the best interests of the client as required by ICOB 6. 1R. A further incorrect approach that prioritizes speed of resolution over accuracy and thoroughness, such as offering a settlement without a detailed investigation into the root cause of the system failure and its direct link to the insured's professional services, would also be a significant regulatory and ethical failure. This could result in an inadequate settlement for the policyholder and a failure to properly assess the insurer's exposure, contravening the principles of fair claims handling and TCF. Professional decision-making process for similar situations should involve a structured approach. First, meticulously review the policy wording, paying close attention to definitions of professional services, errors, omissions, and any specific technology-related endorsements or exclusions. Second, identify and consult relevant regulatory guidance, such as the FCA Handbook, ICOBs, to understand obligations regarding claims handling, fair treatment, and communication. Third, conduct a thorough investigation into the facts of the claim, including the nature of the software error, the extent of the data breach or system failure, and the direct causal link to the insured's professional services. Fourth, assess coverage based on the policy terms and regulatory requirements, documenting all decisions and rationale. Finally, communicate clearly and transparently with the policyholder throughout the claims process. Question 8. Compliance review shows that a client engaged in a professional services dispute is eager to resolve the matter quickly and cost-effectively through mediation, believing it will preserve their professional liability insurance policy's integrity. As a professional liability insurance specialist, what is the most appropriate course of action? Option A. Advise the client on the specific implications of mediation for their professional liability insurance coverage, including potential impacts on insurer subrogation rights and future claims, and ensure they understand the consequences before proceeding. Option B. Recommend arbitration as a more definitive resolution method, as it typically provides a final outcome that can simplify insurance matters. Option C. Suggest the client withdraw from any potential ADR and focus solely on direct negotiation to avoid any complications with their professional liability insurance. Option D. Immediately agree to the client's request to proceed with mediation, assuring them that it is generally beneficial for preserving insurance policy integrity. The correct answer is A. Advise the client on the specific implications of mediation for their professional liability insurance coverage, including potential impacts on insurer subrogation rights and future claims, and ensure they understand the consequences before proceeding. Explanation. This scenario presents a professional challenge due to the inherent tension between a client's desire for a swift and cost-effective resolution and the specialist's duty to ensure all potential professional liability risks are adequately considered and addressed. The specialist must balance the client's immediate needs with the long-term implications of the chosen dispute resolution method, particularly concerning the preservation of rights and the potential for future claims. Careful judgment is required to recommend a path that aligns with both client objectives and regulatory expectations for professional conduct. The correct approach involves advising the client on the implications of mediation and arbitration concerning their professional liability insurance coverage and potential future claims. This includes explaining how participation in mediation might affect the insurer's subrogation rights or the insured's ability to later claim against the policy if the dispute escalates. Similarly, understanding the binding nature of arbitration and its potential impact on policy terms and conditions is crucial. The specialist must ensure the client makes an informed decision, understanding that while ADR can be efficient, it may have specific consequences for their insurance and legal standing, which aligns with the regulatory framework's emphasis on client best interests and transparent advice. An incorrect approach would be to simply agree to the client's preference for mediation without a thorough discussion of its implications for their professional liability insurance. This fails to uphold the duty of care by not fully informing the client of potential risks and consequences related to their insurance coverage, which could lead to a denial of future claims or a misunderstanding of policy terms. Another incorrect approach would be to recommend arbitration solely based on its perceived speed, without adequately assessing whether the arbitration agreement adequately protects the insured's rights under their professional liability policy, or whether it might inadvertently waive rights that the insurer would typically protect. This overlooks the specialist's responsibility to ensure that the chosen ADR method does not prejudice the client's insurance position. The professional reasoning process should involve a comprehensive risk assessment of the proposed ADR method in the context of the client's professional liability insurance. This includes understanding the client's objectives, identifying potential liabilities, evaluating the specific terms and conditions of the professional liability policy, and then advising on how the chosen ADR method might impact coverage, insurer obligations, and the client's ability to recover under the policy. The specialist must act as a trusted advisor, ensuring the client is empowered to make an informed decision based on a clear understanding of all relevant professional liability insurance considerations. Question 9. The assessment process reveals that a professional liability insurance policy is being renewed for a firm that has been in continuous practice for 15 years. The firm has had a claims-made policy in place for the last 10 years, with the most recent insurer being the current provider. The firm's principal has requested that the retroactive date on the new policy be set to the inception date of the current policy, 10 years ago, citing that this is when they believe their significant professional activities began. Which of the following approaches best aligns with regulatory compliance and professional best practices for establishing the retroactive date on the renewed policy? Option A. Accept the principal's assertion that significant professional activities began 10 years ago and set the retroactive date accordingly without further investigation. Option B. Apply a discovery clause retroactively to cover any claims that might arise from services rendered before the current policy inception, even if the insured was aware of potential issues. Option C. Set the retroactive date to the inception date of the current policy, as requested by the principal, to simplify the renewal process. Option D. Establish the retroactive date to the earliest date the firm commenced providing the professional services for which coverage is sought, provided this aligns with underwriting guidelines and the firm's documented history. The correct answer is D. Establish the retroactive date to the earliest date the firm commenced providing the professional services for which coverage is sought, provided this aligns with underwriting guidelines and the firm's documented history. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of retroactive date clauses and their implications for coverage continuity, directly impacting the insured's protection against claims arising from past professional services. Misinterpreting these clauses can lead to significant coverage gaps, exposing both the insured and the insurer to financial and reputational risk. The core of the challenge lies in ensuring that the policy's retroactive date accurately reflects the commencement of the insured's professional activities for which coverage is intended, and that any changes in policy periods do not inadvertently create a lapse in protection. The correct approach involves a thorough review of the insured's history of professional practice and the insurer's underwriting guidelines to establish a retroactive date that aligns with the earliest date the insured provided the relevant professional services. This ensures that claims arising from services rendered prior to the current policy period, but after the established retroactive date, are covered. This aligns with the fundamental principle of indemnity, which aims to place the insured in the same financial position they would have been in had the loss not occurred. Regulatory frameworks, such as those governing professional liability insurance, emphasize clear and unambiguous policy terms and conditions to prevent misrepresentation and ensure adequate consumer protection. Establishing an appropriate retroactive date is crucial for fulfilling this obligation, as it defines the scope of coverage for past acts. An incorrect approach that sets the retroactive date to the inception of the current policy period, without considering prior continuous coverage, fails to provide protection for services rendered between the commencement of the insured's practice and the current policy inception. This creates a significant coverage gap, potentially violating the insurer's duty to provide coverage as understood by the insured based on their continuous professional activity. Such an oversight could be construed as a misrepresentation of coverage or a failure to exercise due diligence in underwriting, leading to regulatory scrutiny and potential penalties for inadequate consumer protection. Another incorrect approach, which is to simply accept the insured's stated retroactive date without independent verification or consideration of underwriting guidelines, risks insuring unknown prior acts. This can lead to adverse selection and increase claims frequency beyond what was anticipated during underwriting. Regulators expect insurers to underwrite risks prudently, which includes verifying information relevant to coverage, especially concerning prior acts. Failing to do so can undermine the solvency of the insurer and the fairness of the insurance market. A third incorrect approach, which is to apply a discovery clause retroactively without clear policy language or regulatory approval, is problematic. While some policies may include discovery clauses, their application must be consistent with the policy terms and relevant regulations. Retroactively applying such a clause to create coverage for acts that occurred and were known to the insured before the policy period, but not reported, can be seen as an attempt to circumvent the intent of retroactive date provisions and may be disallowed by regulators concerned with preventing moral hazard and ensuring clear contractual obligations. The professional decision-making process for similar situations should involve a systematic review of the insured's professional history, a clear understanding of the policy's retroactive date provisions and their implications, and adherence to the insurer's underwriting and claims handling guidelines. When in doubt, consulting with legal counsel or senior underwriting expertise is advisable to ensure compliance with regulatory requirements and ethical obligations to provide accurate and comprehensive coverage. Question 10. The assessment process reveals that Mr. Alastair Finch, a solicitor applying for professional liability insurance, has been practicing law for 25 years. His application details indicate he has primarily handled general litigation and conveyancing. However, he is now seeking coverage for a new specialization in complex international arbitration, a field where his direct experience is limited to 2 minor advisory roles over the past 5 years. Which approach to evaluating Mr. Finch's experience and qualifications is most appropriate for determining his eligibility and premium for this specialist professional liability insurance? Option A. Denying coverage outright due to his limited direct experience in international arbitration, regardless of his extensive general practice. Option B. Relying solely on his 25 years of general legal practice as sufficient evidence of his capability to handle the risks of international arbitration. Option C. Requiring Mr. Finch to provide detailed evidence of his training, any specific certifications in international arbitration, and a comprehensive overview of the complexity and nature of any international arbitration matters he has advised on, alongside a review of his general litigation experience for transferable risk factors. Option D. Granting coverage at a standard rate for solicitors with 25 years of experience, assuming his general legal background provides sufficient transferable skills for international arbitration. Correct answer is D. Granting coverage at standard rate for solicitors with 25 years of experience, assuming his general legal background provides sufficient transferable skills for international arbitration. Explanation. This scenario presents a professional challenge because evaluating a professional's experience and qualifications for specialist liability insurance requires a nuanced understanding of their past performance, the complexity of their work, and the specific risks associated with their profession. It is not merely about ticking boxes, but about assessing the depth and relevance of their expertise. A superficial review can lead to underinsurance or the denial of coverage to a deserving professional, while an overly lenient assessment can expose the insurer to unacceptable risk. The core challenge lies in balancing the need to accurately gauge risk with the imperative to act fairly and ethically towards the applicant, adhering strictly to the regulatory framework governing professional liability insurance. The correct approach involves a comprehensive review of the applicant's professional history, including their educational background, relevant certifications, years of practice in the specific specialty, the nature and complexity of cases handled, and any disciplinary actions or claims history. This approach aligns with the regulatory duty of care for insurers to conduct thorough underwriting, ensuring that premiums accurately reflect the assessed risk. It also upholds ethical principles by providing a fair and transparent evaluation process. The regulatory framework for professional liability insurance specialists mandates that insurers must have robust systems for assessing risk, which inherently includes evaluating the qualifications and experience of the insured professional. This ensures that coverage is appropriate and that the insurer can meet its obligations. An incorrect approach that focuses solely on the number of years in practice without considering the quality or relevance of that experience is flawed. This fails to acknowledge that experience gained in a different specialty or in a less complex environment may not adequately prepare a professional for the risks associated with their current practice. This approach risks mispricing the policy and potentially leading to claims that are not adequately covered by the premium collected, violating the principle of prudent underwriting. Another incorrect approach that relies heavily on self-reported information without independent verification is also problematic. While self-reporting is a starting point, professional liability insurance requires a degree of due diligence. Failing to verify key qualifications or the nature of past work can lead to an inaccurate risk assessment. This can result in the insurer taking on risks they did not anticipate or adequately price for, potentially jeopardizing the insurer's financial stability and its ability to pay legitimate claims. This also raises ethical concerns regarding the insurer's responsibility to its policyholders and the broader market. A professional decision-making process in such situations should involve a structured risk assessment framework. This framework should include clear criteria for evaluating experience and qualifications, a process for verifying information, and a mechanism for escalating complex cases to senior underwriters or specialists. It requires a commitment to continuous learning about evolving professional practices and associated risks, ensuring that assessment criteria remain relevant and effective. Question 11. Operational review demonstrates that a client engaged a financial consultant to advise on investment strategies. The contract stipulated that the consultant would provide quarterly reports and recommendations. The client claims that the consultant provided advice that led to significant investment losses, and that the consultant failed to deliver the promised quarterly reports on time, causing further disruption. The client is seeking compensation for these losses and the inconvenience. Which of the following best describes the specialist's primary focus in assessing this situation for potential professional liability coverage? Option A. Determining if the consultant's advice fell below the accepted standard of care for financial professionals, leading to foreseeable financial loss for the client, and if the failure to deliver reports on time constituted a breach of the duty of care in professional practice. Option B. Evaluating whether the client can demonstrate that the consultant acted with malicious intent or gross negligence in providing the investment advice, as opposed to simple errors in judgment or market fluctuations. Option C. Verifying if the consultant strictly adhered to all contractual deadlines for report delivery, and if the investment advice, while resulting in losses, was technically within the parameters of the agreed-upon investment strategy outlined in the contract. Option D. Assessing the overall financial performance of the client's investments during the period of engagement, regardless of the specific advice given, to ascertain if the consultant's involvement negatively impacted the client's portfolio. The correct answer is A. Determining if the consultant's advice fell below the accepted standard of care for financial professionals, leading to foreseeable financial loss for the client, and if the failure to deliver reports on time constituted a breach of the duty of care in professional practice. Explanation. This scenario is professionally challenging because it requires a specialist to navigate the complex interplay between contractual obligations and the duty of care owed by a consultant. The core difficulty lies in distinguishing between a mere contractual dispute and a claim for professional negligence, which has distinct legal and regulatory implications. A specialist must carefully assess whether the consultant's actions or omissions fall below the accepted standard of professional practice, leading to foreseeable loss, or if they simply represent a failure to meet agreed-upon contractual terms. This distinction is critical for determining coverage under professional liability insurance and for advising clients appropriately. The correct approach involves a thorough investigation into the consultant's conduct, focusing on whether they breached their duty of care by providing advice or performing services that a reasonably competent professional in their field would not have provided or performed. This requires examining the scope of the engagement, the specific advice given, the client's reliance on that advice, and the resulting loss. Regulatory and ethical justification for this approach stems from the fundamental principles of professional conduct, which mandate that professionals act with due care, skill, and diligence. Failure to meet this standard constitutes negligence, a primary trigger for professional liability claims. Furthermore, insurance policies are designed to cover such negligence, not simply breaches of contract, that do not involve a failure in professional skill. An incorrect approach would be to solely focus on whether the consultant fulfilled the explicit terms of the contract. While contractual breaches are important, this approach overlooks the independent duty of care that professionals owe their clients. A consultant might technically fulfill all contractual obligations, but still be liable for negligence if their advice, though contractually compliant, was fundamentally flawed and caused harm. This fails to acknowledge the regulatory expectation that professionals adhere to a higher standard of competence and diligence beyond mere contractual adherence. Another incorrect approach is to assume that any financial loss incurred by the client automatically constitutes a claim for professional negligence. This overlooks the need to prove that the loss was a direct consequence of the consultant's substandard professional conduct. Without establishing a causal link between the alleged negligence and the loss, a claim for professional liability cannot be substantiated. This approach is ethically and regulatorily unsound, as it could lead to unfounded claims and misallocation of resources. A third incorrect approach is to dismiss the situation as a simple business dispute without considering the potential for professional negligence. This fails to recognize that professional services, by their nature, carry an inherent risk of error or omission that can lead to significant financial or reputational damage for the client. Professional liability insurance exists precisely to address these risks, and a specialist's role is to identify and assess such potential claims, not to prematurely categorize them as non-insurable business disputes. The professional decision-making process for similar situations should involve a systematic evaluation. First, clearly define the scope of the consultant's engagement and the agreed-upon services. Second, gather all relevant documentation, including contracts, correspondence, reports, and advice provided. Third, assess the consultant's actions against the established standards of professional practice within their discipline. Fourth, determine if there is a direct causal link between any identified substandard conduct and the client's loss. Finally, consider the applicable legal and regulatory frameworks governing professional liability and insurance coverage. Question 12. The efficiency study reveals that a significant portion of the professional liability insurance team's time is spent on pricing new business applications. To streamline this process and remain competitive, the team is considering adopting new pricing strategies. Which of the following strategies best aligns with the regulatory framework for pricing professional liability insurance, ensuring both competitiveness and regulatory compliance? Option A. Adopting a strategy that sets premiums significantly higher than the market average to build substantial reserves and ensure maximum profitability, assuming this will deter less desirable clients. Option B. Implementing a pricing strategy that primarily benchmarks against the premiums charged by key competitors for similar professional services, adjusting only for minor differences in coverage limits. Option C. Focusing pricing efforts on the perceived ease of processing applications from certain professional groups, offering lower premiums to those perceived as less complex to underwrite, regardless of their actual risk profile. Option D. Developing a pricing model that incorporates a detailed analysis of the insured's specific professional activities, historical claims data, geographic risk factors, and the scope of services provided, using this data to derive a risk-based premium. Correct answer is B. Implementing a pricing strategy that primarily benchmarks against the premiums charged by key competitors for similar professional services, adjusting only for minor differences in coverage limits. Explanation. This scenario is professionally challenging because it requires an insurance underwriter to balance the need for competitive pricing with the regulatory imperative to ensure solvency and fairness. Mispricing can lead to adverse selection, inadequate reserves, and ultimately, financial instability for the insurer, which has direct implications for policyholder protection. Furthermore, regulatory bodies often scrutinize pricing practices to prevent discriminatory or exploitative behavior. The underwriter must therefore apply a nuanced understanding of risk, market dynamics, and the specific regulatory framework governing professional liability insurance. The correct approach involves a comprehensive analysis of all relevant risk factors, including the insured's professional activities, claims history, geographic location, and the specific professional services offered. This data is then used to assign a premium that accurately reflects the probability and severity of potential claims, while also considering the insurer's own cost structure and desired profit margin. This aligns with the regulatory requirement to establish premiums that are not excessive, inadequate, or unfairly discriminatory. The goal is to ensure that premiums are sufficient to cover anticipated losses and expenses, thereby maintaining the insurer's financial soundness and ability to meet its obligations to policyholders. An incorrect approach that relies solely on competitor pricing without independent risk assessment is professionally unacceptable. This fails to account for the unique risk profile of the insured and can lead to underpricing, jeopardizing the insurer's financial stability and potentially exposing policyholders to future premium increases or coverage limitations if the insurer struggles financially. It also risks violating the principle of not unfairly discriminating, as similar risks might be priced differently based on market pressures rather than inherent risk. Another incorrect approach that focuses exclusively on maximizing short-term profit by significantly inflating premiums above actuarially sound levels is also professionally unsound. This can lead to market exclusion, where qualified professionals are priced out of obtaining necessary insurance. It may also be viewed as excessive by regulatory authorities, potentially leading to fines or sanctions. It fails to uphold the ethical obligation to provide fair value and can damage the reputation of the insurance industry. The professional decision-making process for pricing professional liability policies should involve a systematic evaluation of risk, adherence to actuarial principles, and a thorough understanding of the applicable regulatory environment. This includes utilizing robust data analytics, consulting with actuarial experts, and regularly reviewing pricing models to ensure they remain appropriate and compliant. The underwriter must act as a fiduciary, prioritizing the long-term financial health of the insurer and the protection of its policyholders, rather than succumbing to short-term market pressures or the temptation of excessive profit. Question 13. What factors determine whether a real estate agent has fulfilled their professional duty of care and disclosure obligations when a buyer later alleges negligence due to an undisclosed structural issue in a property? Option A. The agent's belief that the structural issue was minor and would not significantly impact the property's value or the buyer's decision. Option B. The agent's diligent investigation of the property's condition, their proactive inquiry into potential issues, and the clear, documented disclosure of all known material facts to the buyer. Option C. The agent's reliance on the seller's verbal assurances regarding the property's structural integrity without any independent verification. Option D. The agent's focus on facilitating a quick sale by highlighting the property's positive attributes while omitting any mention of potential structural concerns. The correct answer is B. The agent's diligent investigation of the property's condition, their proactive inquiry into potential issues, and the clear, documented disclosure of all known material facts to the buyer. Explanation. This scenario presents a professionally challenging situation for a real estate agent due to the potential for significant financial and reputational damage arising from allegations of misrepresentation and failure to disclose material facts. The core challenge lies in balancing the agent's duty to their client, the seller, with their duty of care to potential buyers, which includes providing accurate information and not misleading parties. The agent must navigate complex legal and ethical obligations, where a failure to act diligently and honestly can lead to claims of negligence, breach of contract, and statutory violations. Careful judgment is required to ensure all disclosures are made accurately and promptly, and that no representations are made that could be construed as misleading or false. The correct approach involves a thorough investigation of the property's condition, diligent inquiry into any known defects or issues, and clear, documented communication of all material facts to potential buyers. This aligns with the agent's statutory obligations under consumer protection legislation and professional conduct rules, which mandate honesty, transparency, and acting in the best interests of all parties involved in a transaction, within the bounds of their agency agreement. Specifically, regulations governing real estate professionals typically require agents to disclose any latent defects known to them that are not readily apparent to a buyer. Failure to do so constitutes a breach of duty and can lead to claims of negligence and misrepresentation. An incorrect approach of downplaying or omitting known defects, even if not explicitly asked about, is professionally unacceptable. This constitutes a failure to disclose material facts, which can be interpreted as misrepresentation by omission. Such actions violate the agent's duty of care and honesty, exposing them to liability for damages suffered by the buyer. Another incorrect approach of relying solely on the seller's assurances without independent verification or further inquiry is also problematic. While agents are entitled to rely on information provided by their clients, they have a professional responsibility to exercise due diligence and not blindly accept statements that may be inaccurate or incomplete, especially when those statements relate to the physical condition of the property. This can lead to negligence claims if the buyer suffers loss due to an undisclosed defect. Finally, an approach that prioritizes closing the sale over ensuring full and accurate disclosure is a fundamental ethical and regulatory failure. The agent's primary responsibility is to facilitate a transaction based on accurate information, not to expedite a sale by withholding or misrepresenting material facts. The professional decision-making process for similar situations should involve a systematic evaluation of all known information about the property, a clear understanding of disclosure obligations under relevant legislation and professional codes of conduct, and a commitment to transparent communication. When in doubt about the materiality of a fact or the adequacy of disclosure, agents should err on the side of caution, seeking clarification or advising the seller to obtain expert opinions, and ensuring all disclosures are in writing and acknowledged by the buyer. Question 14. Examination of the data shows that a company has experienced significant financial losses following a series of strategic decisions made by its board of directors. A key shareholder group is alleging that the directors breached their fiduciary duties, leading to this downturn. The board claims their decisions were made in good faith, based on the information available at the time, and were intended to navigate a challenging market. The professional liability insurance specialist is tasked with assessing the validity of these claims. Which of the following approaches best aligns with the regulatory framework and professional standards for assessing directors' and officers' liability in this context? Option A. Conclude that any deviation from the approved annual budget, regardless of the circumstances or subsequent justification, automatically constitutes a breach of fiduciary duty. Option B. Conduct a detailed review of the board's decision-making processes, the information available to them, the advice they received, and whether their actions were consistent with their duties of care, skill, and loyalty under the Companies Act 2006 and the principles of the UK Corporate Governance Code. Option C. Prioritize the immediate demands of the vocal shareholder group to mitigate further shareholder discontent, assuming their interpretation of the director's actions is correct. Option D. Focus on the negative financial outcome and the shareholder group's allegations to determine if a breach of fiduciary duty occurred. The correct answer is D. Focus on the negative financial outcome and the shareholder group's allegations to determine if a breach of fiduciary duty occurred. Explanation. This scenario is professionally challenging because it requires the specialist to navigate the complex interplay between corporate governance, fiduciary duties, and the potential for professional negligence claims against directors and officers. The core difficulty lies in discerning whether actions taken by the board constitute a genuine business judgment, albeit one that resulted in financial distress, or a breach of their duty of care or loyalty, thereby exposing them to liability. The specialist must apply a deep understanding of the relevant regulatory framework, specifically the UK Corporate Governance Code and relevant Companies Act provisions, to assess the adequacy of the board's decision-making processes and their adherence to their statutory and common law duties. The correct approach involves a thorough review of the board's minutes, internal reports, external advice sought, and the overall decision-making process leading up to the financial difficulties. This approach correctly focuses on whether the directors acted with reasonable skill and care, in good faith, and for the benefit of the company as a whole, considering the interests of all stakeholders. It aligns with the principles of directors' duties under the Companies Act 2006, e.g., duty to promote the success of the company, duty to exercise reasonable care, skill, and diligence, and the expectations set out in the UK Corporate Governance Code regarding board effectiveness, risk management, and internal controls. The specialist must determine if the director's actions were based on sufficient information, and if they exercised independent judgment, rather than simply rubber-stamping management proposals or acting in their own self-interest. An incorrect approach that focuses solely on the negative financial outcome without examining the process is flawed. This fails to acknowledge the business judgment rule, which protects directors from liability for honest mistakes of judgment made in good faith and with due care. Such an approach would unfairly penalize directors for decisions that were reasonable at the time they were made, even if subsequent events proved them to be unsuccessful. This overlooks the regulatory expectation that directors are empowered to make commercial decisions, and liability should only arise from demonstrable failures in process or duty. Another incorrect approach that prioritizes the immediate satisfaction of a vocal minority shareholder group over the long-term interests of the company and all its stakeholders would be a failure to uphold the duty to promote the success of the company for the benefit of its members as a whole. This duty, enshrined in the Companies Act 2006, requires directors to consider a range of factors, including the interests of employees, suppliers, customers, the community, and the environment. Focusing on a narrow, immediate demand without this broader consideration is a direct contravention of their fiduciary responsibilities. A further incorrect approach that assumes any deviation from a pre-approved budget, regardless of the circumstances, constitutes a breach of duty is also problematic. While budgets are important for financial control, directors must have the flexibility to respond to unforeseen events or opportunities. Liability should stem from a failure to adequately monitor financial performance, to understand the reasons for deviations, or to take appropriate corrective action, rather than from the deviation itself. This overlooks the dynamic nature of business and the need for adaptive decision-making. The professional reasoning process for such situations should involve a systematic evaluation of the director's conduct against their statutory and common law duties, as well as relevant corporate governance best practices. This includes gathering all relevant documentation, interviewing key individuals, and critically assessing the information available to the board at the time of decision-making. The specialist must then form an objective opinion on whether the directors acted reasonably and in good faith, considering the context and the available information, rather than judging their actions with the benefit of hindsight. Question 15. When evaluating a professional liability insurance claim where litigation is reasonably foreseeable, what is the most appropriate course of action for a professional liability insurance specialist to ensure compliance with legal and ethical obligations regarding evidence preservation? Option A. Recommend that the insured continue with their normal document retention and destruction policies until a formal discovery request is received. Option B. Advise the insured to preserve only those documents that are explicitly requested by the opposing party once litigation has commenced. Option C. Instruct the insured to delete any documents or electronic data that appear to be unfavorable to their position in the potential litigation to streamline the process. Option D. Advise the insured to immediately implement a litigation hold to preserve all potentially relevant documents, electronically stored information, and physical evidence, and to cease any routine destruction of such information while coordinating with legal counsel. The correct answer is D. Advise the insured to immediately implement a litigation hold to preserve all potentially relevant documents, electronically stored information, and physical evidence, and to cease any routine destruction of such information while coordinating with legal counsel. Explanation. This scenario is professionally challenging because it requires an insurance specialist to navigate the complexities of legal discovery and evidence preservation, while acting within the strict confines of professional duty and regulatory compliance. The specialist must balance the insured's desire for a swift resolution with the legal obligations to preserve relevant information, understanding that failure to do so can have severe consequences for both the insured and the insurer, including potential sanctions and reputational damage. Careful judgment is required to distinguish between routine information gathering and the preservation of evidence that may be critical to a legal proceeding. The correct approach involves a proactive and systematic process of identifying, preserving, and managing potentially relevant information. This includes understanding the scope of any potential litigation, communicating clearly with the insured about their obligations, and implementing appropriate measures to prevent the destruction or alteration of data. This aligns with the principles of good faith and fair dealing expected of insurance professionals, and is often mandated by rules of civil procedure and professional conduct guidelines that emphasize the importance of preserving evidence once litigation is reasonably foreseeable. The specialist's role is to facilitate compliance and protect the interests of all parties by ensuring the integrity of the evidence. An incorrect approach that involves advising the insured to delete or discard information that might be relevant to a potential claim is a direct violation of legal and ethical obligations. This action could be construed as obstruction of justice or spoliation of evidence, leading to severe legal penalties for the insured and professional sanctions for the specialist. Another incorrect approach, which is to ignore the possibility of litigation and continue with normal business operations without implementing any preservation measures, fails to meet the duty of care owed to the insured and the legal system. This passive stance can result in the inadvertent loss of crucial evidence, prejudicing the defense of the claim and potentially exposing the insurer to liability. A third incorrect approach, which is to overzealously preserve all information without proper assessment or communication, can lead to unnecessary costs and burdens for the insured and may not be legally required. It demonstrates a lack of understanding of the proportionality and relevance required in discovery. Professionals should adopt a decision-making framework that begins with identifying potential legal exposure early. Upon recognizing the likelihood of litigation, the specialist should immediately consult with legal counsel to understand the specific preservation obligations. A clear communication strategy with the insured is paramount, outlining their responsibilities and the measures to be taken. The specialist should then work with the insured to implement a defensible litigation hold process, ensuring that relevant data is identified, preserved, and managed appropriately, while also considering the proportionality of these efforts. Question 16. The efficiency study reveals that a significant portion of the firm's new business inquiries are from entities providing advisory or specialized technical services, rather than traditional licensed professions. When assessing these inquiries for professional liability insurance, which approach best ensures accurate identification of professionals and their unique exposures, thereby fulfilling regulatory obligations for appropriate coverage. Option A. Rely solely on the client's self-declaration of their professional status and the types of services they believe fall under professional liability, without independent verification or detailed exposure analysis. Option B. Categorize all entities providing advice or specialized technical services as professionals, and conduct a detailed analysis of their specific service offerings to identify potential errors and omissions exposures, tailoring coverage accordingly. Option C. Apply a standard business owner's policy with a broad professional liability endorsement to all entities that describe themselves as providing services, without delving into the specifics of their professional activities. Option D. Assume that only entities with formal licensing or professional body membership qualify as professionals for insurance purposes, and therefore, only these entities require professional liability insurance. The correct answer is B. Categorize all entities providing advice or specialized technical services as professionals, and conduct a detailed analysis of their specific service offerings to identify potential errors and omissions exposures, tailoring coverage accordingly. Explanation. This scenario presents a professional challenge because the definition of a professional for liability insurance purposes can be nuanced, extending beyond commonly recognized roles. Identifying the unique exposures of each professional entity is crucial for accurate risk assessment and appropriate policy wording. Misclassifying a professional or failing to understand their specific operational risks can lead to underinsurance, coverage gaps, or claims being denied, all of which have significant financial and reputational consequences for both the insured and the insurer. Careful judgment is required to interpret the scope of professional services and the potential for errors or omissions within those services. The correct approach involves a thorough review of the services provided by each entity against established professional definitions and common law interpretations relevant to professional liability. This requires understanding the specific duties and responsibilities inherent in each profession, as well as the typical types of claims that arise from the performance or non-performance of those duties. For example, a management consultant's exposure might stem from flawed strategic advice, while a software developer's exposure could arise from coding errors leading to data breaches. This detailed understanding allows for the correct classification of the professional and the accurate identification of their unique exposures, ensuring appropriate coverage is placed. This aligns with the regulatory requirement to provide adequate and suitable insurance products that reflect the actual risks undertaken by the insured. An incorrect approach would be to assume that only traditionally licensed professionals, e.g., doctors, lawyers, are subject to professional liability insurance. This overlooks the growing number of service providers whose advice or expertise can lead to financial loss for their clients, such as IT consultants, marketing agencies, or HR advisors. Failing to recognize these entities as professionals with unique exposures can lead to them being uninsured or inadequately insured, violating the principle of fair representation of risk. Another incorrect approach is to apply a generic liability policy to all service providers without considering the specific nature of their professional services. Professional liability policies are designed to cover specific types of negligence unique to professional advice and services, which differ significantly from general liability that covers physical injury or property damage. Using a generic policy would likely exclude coverage for the very errors and omissions that constitute professional liability, leaving the insured exposed. A third incorrect approach is to rely solely on the client's self-assessment of their professional status without independent verification. While a client's understanding is important, it may be incomplete or inaccurate. The insurer has a responsibility to conduct due diligence to ensure the correct classification and coverage are in place, based on the actual services rendered and the regulatory landscape. Failure to do so can result in mispriced premiums and inadequate coverage, which is a breach of professional duty. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the client's business and the specific services they offer. 2. Research and apply the relevant legal and regulatory definitions of professional and professional services within the applicable jurisdiction. 3. Identify the potential for errors, omissions, or negligence in the performance of those services that could lead to financial loss for a third party. 4. Assess the unique exposures associated with each identified professional service. 5. Determine the most appropriate type of professional liability insurance coverage and policy wording to address these exposures. 6. Document the decision-making process and the rationale for classification and coverage selection. Question 17. System analysis indicates a client, a consulting engineer, is transitioning to a new professional liability insurance carrier. The client has been insured continuously for the past 15 years. The proposed new claims-made policy has an inception date of January 1, 2024, and includes a retroactive date of January 1, 2010. The client asks if this new policy will cover any claim made against them in 2024, even if the alleged error or omission occurred in 2011. What is the most accurate and professionally responsible approach for the specialist to advise the client? Option A. Advise the client that the new policy will cover the claim because the client has had continuous professional liability insurance coverage for 15 years, and the new policy effectively extends coverage for all prior work. Option B. Advise the client that the new policy will cover the claim because it is a claims-made policy, and the claim is being made during the policy period, and the retroactive date ensures coverage for work performed since 2010. Option C. Advise the client that the new policy will not cover the claim because the alleged error occurred in 2011, which is prior to the policy's inception date, and claims-made policies only cover claims made for work performed during the current policy period. Option D. Advise the client that the new policy will cover the claim because the claim is being made during the policy period, and the retroactive date of January 1, 2010, means that any claim arising from services rendered on or after that date will be covered, provided it is reported within the policy period. The correct answer is B. Advise the client that the new policy will cover the claim because it is a claims-made policy, and the claim is being made during the policy period, and the retroactive date ensures coverage for work performed since 2010. Explanation. This scenario presents a professional challenge due to the inherent complexities of claims-made policy forms and the critical need for accurate advice regarding retroactive dates and prior acts coverage. A professional liability insurance specialist must navigate the nuances of when a claim is considered made and how it relates to the policy period and any endorsements that extend coverage for work performed prior to the policy's inception. Misinterpreting these provisions can lead to significant coverage gaps, exposing the insured to substantial financial risk, and potentially leading to professional negligence claims against the specialist. Careful judgment is required to ensure the insured fully understands their coverage limitations and benefits. The correct approach involves a thorough review of the claims-made policy wording, specifically focusing on the definition of claim, the policy period, and any endorsements related to retroactive dates or prior acts. The specialist must then clearly communicate to the client that coverage is triggered only when a claim is first made against the insured and reported to the insurer during the policy period, provided the claim arises from services rendered on or after the specified retroactive date. This approach is correct because it directly aligns with the fundamental principles of claims-made coverage as defined by standard professional liability insurance policy forms and regulatory guidance that emphasizes clear disclosure of policy terms and conditions. Adhering to these principles ensures the insured is adequately informed and protected according to the policy's intent. An incorrect approach would be to advise the client that coverage is guaranteed for any work performed during their professional career, regardless of when the claim is made or reported, simply because they have a claims-made policy in place. This fails to acknowledge the core claims-made trigger and the importance of the retroactive date. This approach is ethically and regulatorily flawed as it misrepresents the scope of coverage, potentially leading the insured to believe they are protected when they are not, violating the duty of care and the obligation to provide accurate advice. Another incorrect approach would be to focus solely on the policy's inception date without considering the retroactive date endorsement. Advising the client that any claim reported during the policy period is covered, irrespective of when the underlying professional service was rendered, ignores the critical function of the retroactive date in defining the scope of prior acts coverage. This creates a significant risk of a coverage denial if the claim relates to services performed before the retroactive date, even if reported within the current policy period. This constitutes a failure to properly interpret and explain the policy's limitations, breaching professional standards. A third incorrect approach would be to assume that prior acts coverage is automatically included and unlimited in all claims-made policies. This overlooks the fact that claims-made policies typically require specific endorsements for prior acts coverage, often with a defined retroactive date. Recommending a policy based on this assumption, without verifying the presence and terms of such endorsements, would be negligent. This approach fails to conduct due diligence and provide accurate advice regarding the specific policy's coverage, potentially leaving the insured exposed. The professional decision-making process for similar situations should involve a systematic review of the policy documents, a clear understanding of the claims-made trigger, and diligent communication with the client. Specialists must prioritize educating the client about the policy's mechanics, including the significance of the retroactive date and reporting requirements. When in doubt, seeking clarification from the underwriter or insurer is a crucial step. The ultimate goal is to ensure the client makes informed decisions based on a complete and accurate understanding of their coverage. Question 18. Regulatory review indicates that a client, a small architectural firm, is experiencing significant financial pressure and has requested a substantial reduction in their professional liability insurance coverage to lower annual premiums. As a professional liability insurance specialist, what is the most appropriate course of action to maintain adequate insurance coverage while addressing the client's concerns? Option A. Immediately agree to reduce the insurance coverage to the level requested by the client to alleviate their immediate financial burden. Option B. Advise the client to seek insurance from a provider outside the regulated market to find cheaper options. Option C. Inform the client that the coverage can be reduced, but do not elaborate on the implications or explore alternatives. Option D. Proactively explain the regulatory requirements for maintaining a specific minimum level of professional liability insurance, detailing the potential risks of underinsurance, and explore alternative policy options that might offer cost savings within compliance parameters. The correct answer is D. Proactively explain the regulatory requirements for maintaining a specific minimum level of professional liability insurance, detailing the potential risks of underinsurance, and explore alternative policy options that might offer cost savings within compliance parameters. Explanation. This scenario presents a professional challenge because it requires a specialist to balance the immediate financial pressures of a client against their ongoing regulatory obligations to maintain adequate professional liability insurance. The temptation to reduce coverage to save costs can be significant, but it directly conflicts with the fundamental duty to protect both the client and the public from potential financial harm arising from professional negligence. The specialist must exercise sound judgment, prioritizing compliance and risk management over short-term client cost savings. The correct approach involves proactively engaging with the client to explain the regulatory requirements for maintaining a specific level of professional liability insurance, even if the client perceives it as an unnecessary expense. This approach demonstrates a commitment to ethical practice and regulatory adherence. The justification lies in the professional liability insurance specialist's duty to uphold the standards set by the relevant regulatory bodies, which mandate minimum coverage levels to ensure that clients have recourse in the event of a claim. Failure to maintain adequate coverage could lead to regulatory sanctions, reputational damage, and more importantly, leave the client exposed to significant financial loss that the insurance was intended to mitigate. An incorrect approach would be to immediately agree to reduce the insurance coverage to meet the client's cost-cutting request without further investigation or consultation. This fails to acknowledge the regulatory framework that governs professional liability insurance and the specialist's responsibility to ensure compliance. The regulatory failure here is the direct contravention of mandated coverage requirements, exposing the client and potentially the specialist to liability. Another incorrect approach is to simply inform the client that the coverage can be reduced without explaining the implications or exploring alternative solutions. This is a passive and irresponsible response that abdicates the specialist's duty of care. The ethical failure is the lack of proactive advice and guidance, which is a core component of professional service. A third incorrect approach would be to suggest the client seek insurance from a less regulated provider to achieve lower costs. This is professionally unacceptable, as it undermines the integrity of the regulated insurance market and potentially exposes the client to substandard coverage or providers who do not meet the required financial solvency or claims handling standards. The regulatory and ethical failure is the attempt to circumvent established compliance mechanisms and potentially place the client in a more vulnerable position. The professional decision-making process for similar situations should involve 1. Understanding and clearly articulating the specific regulatory requirements for professional liability insurance applicable to the client's profession and services. 2. Communicating these requirements transparently to the client, explaining the rationale behind them and the potential consequences of noncompliance. 3. Exploring all available options within the regulatory framework to address the client's cost concerns, such as adjusting deductibles, exploring different policy structures, or phasing in coverage increases if permissible. 4. Documenting all discussions, advice provided, and decisions made regarding insurance coverage. 5. Seeking clarification from regulatory bodies or professional associations if there is any ambiguity regarding compliance. Question 19. Risk assessment procedures indicate that a professional services firm is seeking to reduce its annual insurance expenditure. The firm's principal has inquired about the possibility of increasing the deductible on their professional liability insurance policy to achieve this objective. As the professional liability insurance specialist, what is the most appropriate course of action? Option A. Clearly explain to the firm's principal that while a higher deductible will lower the premium, it will also significantly increase their out-of-pocket financial responsibility in the event of a claim, and discuss their capacity to absorb such potential losses. Option B. Recommend a deductible level that aligns with the insurer's standard offerings for similar firms, without further inquiry into the firm's specific financial situation. Option C. Proceed with adjusting the deductible to the highest level requested by the firm to immediately reduce their premium, assuming the firm understands the implications. Option D. Advise the firm to select the highest deductible option available to maximize premium savings, as this is a common strategy for cost reduction. The correct answer is A. Clearly explain to the firm's principal that while a higher deductible will lower the premium, it will also significantly increase their out-of-pocket financial responsibility in the event of a claim, and discuss their capacity to absorb such potential losses. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance specialist to balance the client's desire for lower premiums against the potential financial implications of a higher deductible, particularly in the context of professional liability insurance, where claims can be substantial and unpredictable. The specialist must not only understand the mechanics of deductibles, but also the regulatory expectations regarding client advice and the potential impact on the client's ability to manage risk. The specialist's judgment is critical in ensuring the advice provided is both commercially sound and compliant with professional standards. Correct approach analysis. The correct approach involves clearly explaining to the client that while a higher deductible will reduce the immediate premium, it significantly increases the client's out-of-pocket exposure in the event of a claim. This explanation must include a discussion of the client's financial capacity to absorb such a loss and the potential impact on their business operations. This aligns with the regulatory framework's emphasis on providing clear, accurate, and comprehensive advice, ensuring clients understand the full implications of their insurance choices. Professional ethics also dictate a duty of care to act in the client's best interest, which includes ensuring they are not making a decision that could lead to severe financial hardship due to an underestimation of risk. Incorrect approaches analysis. Advising the client solely on the premium reduction without adequately detailing the increased claim exposure fails to meet the regulatory requirement for full disclosure. This approach prioritizes a short-term benefit, lower premium, over the client's long-term financial security and risk management, potentially leading to a breach of duty of care. Recommending the highest possible deductible without understanding the client's financial situation or the nature of their professional risks is irresponsible. This ignores the fundamental principle of matching insurance coverage to the client's specific needs and risk appetite, and it can be seen as a failure to conduct adequate due diligence. Focusing only on the insurer's preferred deductible levels without considering the client's specific circumstances or the potential impact on their ability to manage claims is a dereliction of the specialist's duty to advocate for the client. This approach prioritizes the insurer's interests over the client's, which is contrary to professional conduct standards. Professional reasoning. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's business, risk profile, and financial capacity. This involves active listening and questioning to ascertain their risk tolerance. Next, the specialist must analyze the insurance product, specifically the deductible option, and their direct impact on both premiums and claim handling responsibilities. The core of the decision-making process is then to present these options to the client in a clear, unbiased manner, detailing the trade-offs involved. The specialist must ensure the client fully comprehends the financial implications of each deductible level, particularly the increased out-of-pocket expense associated with higher deductibles. The final decision rests with the client, but the specialist's role is to equip them with the necessary information and guidance to make an informed choice that aligns with their overall risk management strategy and financial stability, all while adhering to regulatory disclosure requirements. Question 20. Cost-benefit analysis shows that a client's potential claim for financial loss due to a consultant's incorrect advice could be substantial. The client's business insurance portfolio includes a general liability policy and a professional liability errors and omissions policy. The consultant's representative argues that the claim is for financial loss resulting from the consultant's advice, which they contend is covered under the general liability policy's broad definition of damages. As a professional liability insurance specialist, how should you advise the client regarding which policy is most likely to respond to this claim? Option A. Advise the client that the general liability policy will cover the claim because it is a broad policy designed to cover most business-related damages, including financial losses. Option B. Advise the client that professional liability, errors and omissions, insurance is designed to cover claims arising from financial losses caused by errors or omissions in professional advice, and general liability typically excludes such claims. Option C. Advise the client that both the general liability and professional liability policies will likely respond equally to this claim, and the insurer will determine which policy pays. Option D. Advise the client that the claim is likely not covered by either policy, as financial losses are generally excluded from standard business insurance. The correct answer is B. Advise the client that professional liability, errors and omissions, insurance is designed to cover claims arising from financial losses caused by errors or omissions in professional advice, and general liability typically excludes such claims. Explanation. This scenario presents a professional challenge because it requires a specialist to accurately distinguish between different types of insurance policies, specifically professional liability insurance and general liability insurance, in the context of a client's potential claim. Misclassifying the insurance coverage could lead to significant financial and legal repercussions for the client, as well as reputational damage for the insurance specialist. The specialist must apply a deep understanding of policy definitions and the nature of the alleged harm to determine which policy is triggered. The correct approach involves meticulously examining the nature of the alleged harm to determine if it arose from a professional error, omission, or negligent act in the provision of professional services. This aligns with the core purpose of professional liability insurance, often referred to as errors and omissions or E&O insurance, which is designed to protect professionals against claims of negligence or inadequacy in their services. Regulatory frameworks, such as those governing insurance intermediaries and advisors, mandate that professionals act in the best interests of their clients and provide advice that is suitable for their needs. This necessitates a thorough understanding of the insurance products being recommended or analyzed. An incorrect approach of solely relying on the broad definition of bodily injury or property damage, as typically covered under general liability insurance, would be a failure to adhere to the specific scope of coverage intended by the policies. General liability insurance is designed to cover third-party claims for bodily injury, property damage, and personal and advertising injury that occur as a result of business operations, but it generally excludes claims arising from professional services. Failing to recognize this distinction means the specialist is not providing accurate advice regarding the client's risk exposure and the appropriate insurance coverage. Another incorrect approach would be to assume that any claim made against a business automatically falls under general liability without considering the specific allegations. This overlooks the fundamental difference between operational risks covered by general liability and professional risks covered by professional liability. This oversight can lead to a client being uninsured for a significant risk, violating the duty of care owed to the client. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's business and services. Gain a comprehensive understanding of the client's operations, particularly the professional services they provide. 2. Analyze the allegations. Carefully review the specific allegations made in the claim or potential claim. What is the client accused of doing or failing to do? 3. Consult policy definitions. Refer to the precise wording of the relevant insurance policies, paying close attention to definitions of professional services, negligence, error, omission, and the exclusions within each policy. 4. Differentiate coverage. Based on the allegations and policy definitions, determine whether the alleged harm stems from a failure in professional service delivery or from a general business operation. 5. Advise appropriately. Clearly communicate the findings to the client, explaining which policy is likely to respond and why, and advising on any potential coverage gaps.